the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking space. Today is the 10th of August and I am Ruchika Chitravanshi. In today's show, our cover story looks into why bank margins are under pressure. In the banker's view, we have with us Anup Bagchi of ICICI Prudential. For our Banking for You segment, we will be discussing the certificate of deposit. Our consulting editor, Tamal Bandyopadhyay, joins us to discuss the RBI's monetary policy. At the end of the show, we will tell you the results of last week's poll and the question for this week. India's banking sector has been having a good run. While loan growth has done well, there are concerns around the margins. Why are banks facing pressures on their margins? Raghu Mohan tells us in our cover story this week.
For Indian banks, the Q1 results have been heartening, to say the least. State-run and private banks posted a combined net profit of Rs 73,393 crore in the first quarter of FY24. This was a rise of 68.8% year-on-year, with a cumulative operating profit of Rs 1,30,716 crore, up 42.8%. State-run banks' net profit more than doubled. It increased by 124.8% on a year-on-year basis to Rs 34,418 crore. For private banks, it went up by 37% year-on-year to Rs 37,683 crore.
I think broadly what we've seen is growth is very good, and asset quality is also holding up nicely. The misses are primarily around margins. So margins have declined. They went up last year. So we are seeing some give back of those exceptionally high numbers. And broadly, operating costs across banks, especially private banks, have been higher, especially attrition rates have also gone up. So broadly, you can say positive is growth and asset quality, negative is the margin and the OPEX. Return on equity, which is, I think, a key measure of banks' profitability, we are seeing broadly hold up to what you would think that these banks would earn on a through cycle basis. So earnings are, let's say, at normalized levels. We are not seeing any upgrades in earnings. So upgrades are very hard to come by, but and in some cases there have been downgrades. So from a stock price perspective, what matters is essentially then the valuation. Whether these valuations can go up or not, which given the rate cycle right now will be hard to argue. So you will basically get compounding. So book value growth, earnings growth is what investors can basically get. Very hard to argue that re-rating will happen on valuations or earnings will get upgraded from here on. So that's broadly, I think, what the first quarter trend shows.
The sterling performance of both categories of banks is on the back of healthy growth in their net interest income or NII and strong credit offtake. In the case of state-run banks, the robust growth in other income and fall in provisions aided in reporting a healthy bottom line according to analysis-based data compiled by BS Research Bureau. The State Bank of India accounted for almost half of the net profit of state-run banks during the period. That said, on a sequential basis, the net profit of state-run banks saw a 0.2% drop from Rs 34,483 crore, with both NII and other income down 0.8% and 17.6% respectively. Private banks saw their NII rise 26.4% YOY to Rs 80,404 crore, reflecting the spike in lending rates. Other income like fees, commissions and revenues grew 39.4% YOY to Rs 29,653 crore in Q1 FY24.
So basically, quarter 4 FY23 depicts a mixed results overall in terms of key trends, we believe that the margins have already peaked out in Q4 FY23. So we were expecting around 10 to 20 basis points NIM compression in Q1 FY24, which was in line. In case of private banks, the NIMs compression was in line with their expectation. However, the negative surprise came from PSU banks back, where we were building our NIM compression of around 10 to 15 basis point versus which came in around more than 20 basis points in terms of NIMs compression. So basically, in terms of key positives, loan growth continues to remain strong, and it was broad based. And in terms of retail deposit growth was also strong and that picked up substantially, which has been led by the term deposits. Although also the if you look at the credit cost, also the credit cost was marginally higher, but although it was lower because due to the Q1 is basically a seasonally a weak quarter in terms of because there are slippages from the agri portfolio and recoveries are also lower in Q1.
In a review, India Ratings said in the current tightening cycle, that is between May 2022 and June 2023, state-run banks have been active in rate transmission on fresh loans while private banks have lagged behind. State-run banks have upped rates by 173 basis points while private banks have upped by 146 basis points. For outstanding loans, the pace of transmission was lower at 96 basis points for state-run banks compared to 105 basis points for private banks. Banks seem to set hold the trajectory mentioned in the Financial Stability Report of June 2023. It had been said that in FY23, banks' net interest margins improved by 30 basis points. Banks' profit after tax recorded a healthy growth of 38.4% year-on-year during FY23, led by a strong increase in net interest income and lowering of provisions. With the interest plot also likely to change dramatically from here on and relatively better credit offtake, banks will continue to be in a sweet spot.
In Banker's View today, we have Anup Bagchi, MD and CEO of ICICI Prudential Life Insurance. He spoke with Business Standard's Manojit Saha on a variety of issues, including the insurance sector and ICICI Prudential's role in it.
Hello and welcome to the Business Standard Banking Show. Anup Bagchi took over as the MD and CEO of ICICI Prudential Life Insurance Company in June. ICICI Prudential Life Insurance Company is one of the largest private company in the private sector. We have Mr. Bagchi with us today. He will talk about his priorities and strategies. Mr. Bagchi, welcome to the show.
Yeah, thank you, Manojit.
The biggest question which is there in everybody's mind is that would you like to turn the focus on growth back on ICICI Prudential Life Insurance?
No, yes, absolutely, Manojit. I think Kannan had done a great job. He has left a great foundation by diversifying the products, by diversifying the channels. And now the focus certainly is the VNB, absolute VNB growth with a slant with contribution of growth. So margin, of course, is there. So, but growth is really where the focus would be. And to drive growth through penetration in different customer segments, through a wider proposition, through diversified channels, because now, as you know, we have the best set of diversified products, propositions, and best set of diversified channels. We have around 40 banking partners. We have 400 plus non-banking partners. So we really have a width of channels and width of proposition and a very wide variety of underlying clients whom we can serve. So certainly, as you rightly said, that is certainly a focus area.
You started with the point of penetration, which means there's a huge opportunity for growth.
Absolutely.
So I mean, ICICI Prudential Life is currently at third position among the private sector life insurance companies. Is there an aspiration to become the number one over the next few years?
No, the aspiration will be that, to keep growing. And if through growth and serving the customers, if we become number one, we'll be very happy and very proud.
Now, since you mentioned about products, coming to your first quarter results, retail production has really done well in
Yes,
this
yes,
quarter.
yes, yes, yes.
What was the key drivers for this kind of growth?
No, no, Manoj, a very interesting question you have raised. If you look at retail protection, we were at 62. There were others who were at 40, 45, and then there were others who were at 20s. So the gap is very wide. So there is a dispersion in
You're talking about the
growth.
growth.
There is a large dispersion in the growth, which is not seen in any other products. All other products, if you see, they are largely clustered around similar growths. But here there is a large dispersion. And I would say that three things I will say really drove our strategy. One is, like I said, our focus is on customers because we went to our database. So there are four things that we are doing. We are doing very deep data analytics to understand our customers. We are also coming out with very diversified propositions which resonate with that customer base. We are using a lot of digitalization to ensure that the onboarding and underwriting is as smooth as possible. So if there is a demand and it comes to us, they get a great experience. And fourth is depth in partnership.
Correct.
And so when we went back and we said, because we also have a 20-year history, as to what is the profile of customers who are taking protection products, with which partners are they sitting with?
Correct.
And so let us create capability within those partners. Let us refresh the capability development. Let us do deeper data analytics to see from an underwriting perspective, what can we do? And from a partner perspective, digitalization so that the onboarding is very smooth. There is digital KYC, they get a very good experience. And diversified proposition within the protection so that we are able to basically have different cuts of underwriting where you can be pre-approved. So just like you have pre-approved personal loans, we have also pre-approved savings sum assured. So for a certain set of customers, we have pre-underwritten them and they come under pre-approved sum assured. On certain other customers, we have full medical. With certain other customers, we have telemedical. So we also have used a lot of data analytics to really power that. And we are also, I must add that we are also seeing some bit of a societal shift also towards protection, because protection is not a very expensive product. It is many people think it's a very expensive product, but on 25,000 rupees, generally a healthy 35-year-old gets a 1 crore cover. That is 400 times. So 1 crore divided by 25,000 is 400. It's 400 times benefit you get.
But group protection policies, are they facing headwinds due to increased pricing post the COVID period?
No, so post the COVID period, it had increased. Now it is again normalizing. It is normalizing. So there is no headwind in group term. But what is happening in group term is that when we look at, because we have a very, very large sort of play in group term also. Now what we are seeing is that actual life, the cover that you get is not very large in group term.
Okay.
It's not very large. And so what is happening is that the general advice is that, first of all, group term will only be there till you are there in a job. If you are not in the job, you will not get group term. So it is absolutely advisable that each one of us, I have taken myself also. So I must disclose, I have myself taken. We must all have group protection, which is independent of our jobs.
Now, coming to the distribution part, the final few questions. Now, ICICI Bank, your parent, has more than 6,000 branches, which is quite huge. So, how do you plan to leverage the ICICI Bank's distribution network?
So ICICI Bank, as you know, see, they have two roles. One is as a shareholder, and second one is as a distributor. I must say that both ICICI Bank and Prudential, both of them are very, very fine shareholders. They are very, very supportive of what we do. And they are very nice. As a shareholder, they are very nice. Now, as a distributor, which is a different hat, ICICI Bank, as you know, generally they focus on the core banking products. And that is what they do. So, and on the insurance side, they have said that they will be, supportive of protection, and they'll be supportive of annuity. And that is what they do. And today they contribute around 15% to our top line.
On that note, sir, it was a pleasure as usual speaking to us. Thank you so much for speaking to Business Standard.
No, thank you. Thank you so very much. And what a pleasure again speaking to you, Manojit.
Thank you, sir.
Certificate of Deposit, commonly called a CD, is a fixed income financial instrument governed under the Reserve Bank of India. CDs are an attractive choice for both conservative investors and those looking to diversify their portfolios. So, what is a certificate of deposit and is it a reliable investment instrument? Abhijit Kumar decodes this investing option.
A certificate of deposit or CD is a time-bound financial product offered by an Indian financial institution or commercial bank. It functions similar to a savings account but with a distinct structure. An individual deposits a certain amount into the CD for a specific period, ranging from a few months to several years, during which the funds remain locked. In return, the issuing institution offers a fixed interest rate that is typically higher than traditional savings accounts. CDs can be issued in India for a minimum deposit of 1 lakh rupees and in subsequent multiples of it. One of the appealing features of a certificate of deposit is the fixed interest rate. This means, regardless of any fluctuations in the financial market, the interest rate remains constant over the agreed upon term. The attractive aspect of CDs is the higher interest rates they offer, sometimes reaching as high as 7.8% on lump sum deposits compared to the average 4% interest on traditional savings accounts. There are no additional costs associated with a CD. One can opt for monthly or annual payouts or a lump sum withdrawal at maturity of the CD. However, while CDs are known for their stability, they do lack liquidity compared to regular savings accounts. Withdrawing funds before the CD's maturity usually incurs a penalty, the amount of which varies with financial institutions and the terms of the specific CD. Certificate of deposits may also offer lower returns compared to investments like stocks and mutual funds, which have the potential for higher gains. Yet CDs continue to be relevant because they provide a secure path to grow one's savings while maintaining a low level of risk. With fixed interest rates and various term options, the instrument offers stability and predictability. But one must remember to assess his financial goals before committing to a specific certificate of deposit to ensure that it aligns with his overall financial strategy.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Low levels of risk will trump the lower returns factor for many when it comes to the certificate of deposit. Moving on to our expert take segment, I spoke with our consulting editor Tamal Bandyopadhyay on the latest monetary policy and its implications. Here's the chat.
Hi Tamal, welcome again to the banking show. We are discussing the RBI monetary policy. The Monetary Policy Committee today has kept the repo rate unchanged at 6.5%. It is quite on expected lines. Can you take us through the key highlights of the monetary policy?
Well, as you rightly said, it's a third time in a row status quo on policy, which is a consensus decision by MPC, as well as the status quo on the stance of the policy, that's withdrawal of approbation. That's, of course, not a consensus decision. Apart from that, what else? I think most critical part is the inflation projection has been raised, which was again on the expected line. It's a very quick, I would say, in 2 months' time between the last policy and now, June and August, 30 basis point hike from 5.1. Last policy, actually, Reserve Bank of India did cut it by 10 basis points. That has gone up to 5.4%. So inflation projection has gone up. Growth projection has kept it as it is, has been kept at 6.5%. And Governor has repeatedly said that India is a new growth engine for the world. So it's very bullish on growth. Inflation also, he's a bit of a downplaying. He's saying it's very transient kind of thing. But at the same time, he is exuding the same confidence that he would win over inflation. And if things go the other way, RBI is in readiness to act, which means all options are open. Future will be data dependent. Other one action it has been taken in terms of action beyond words is this incremental CRR that has been hiked because there is too much of liquidity in the system. So banks will need to keep 10% extra money with the Reserve Bank of India. But he has repeatedly said that it's temporary. It's temporary just for a month. In September, even if not earlier, it would be RBI would review it. So, well, it's look at. I mean, I would call it hawkish pause, and why is it? We'll talk to that later.
All right, hawkish pause. Now, some of the things you have touched upon briefly, but let's delve in deeper. What do you think of the inflation projection that RBI has given, and it has shown concerns as well around some areas? Can you explain a little?
Yeah, actually, that's what exactly I wanted to talk about this. As far as inflation has gone up, which is on the inflation estimate has gone up, which is on the expected line. Okay, and at the same time, he's soothing the frayed nerves. Well, hold on, the core inflation is is under control, and this is by the food shock, so it's okay from 5.1 to 5.4. But for the first time, that's a new number Reserve Bank of India has given for the first quarter of the next fiscal year, which begins in April 2024. For 2024-25, first quarter inflation number he has given, this is 5.2%. Now, 5.2% is way above the 4%, which is inflation target, right? So what does this mean? From that point of view, it's a pretty, even though today market has, as you speak, bond market has not reacted much to the policy. It's basically, the governor's talk that it's a temporary phenomenon. But in the long shot, you see, inflation continues to be high even next year, 5.2%. What does it mean? Definitely it is hawkish, and it is actually pushes the possibility of the first rate hike further. We are discussing earlier, talking about February or June, something like that. I don't expect the first rate cut. I meant the first rate cut from 6.5%, not in the even in the first of next fiscal year. So it has been moved away because inflation will continue to remain high, and 5.2%, that's the new number Reserve Bank of India has given for the first quarter of next fiscal year.
Absolutely. The other thing that you touched upon briefly is the incremental CRR. What are the implications of this move?
Well, this is not for good. This is very temporary because the system is slosh with liquidity. And as you know, if you have high liquidity, that is inflationary. So how do you manage this liquidity? There are three ways of managing it. One is this: the Reserve Bank of India continues to do soak up the money from the bank through its window, which is actually cost to the RBI because it gives money to bank, but the banks are not very excited about keeping the money at the RBI window. That's what the governor said. Second is government historically has done through some kind of MSS kind of bond where the cost is borne by the government. And third is the banking system has to bear the cost. Here in this case, 10% of your additional incremental NDTL. Now the numbers vary, figures vary. It will be anything between 1.1 trillion and 1.2 trillion. That's the extra money the banks will have to keep with Reserve Bank of India, at least for the time being. When did this happen last time? It happened last time post demonetization. As we speak, Italy has gone for a windfall tax imposing on the banks because the fabulous profit they have made on because of the rising interest rates. Now, Indian banks also have been doing great profits. Again, one of the contributing factors is the rising interest rates. So this is one way of taxing the banks, you can say that. And there have been past instances happen. But there's a perception that bulk of this additional liquidity in the system is been contributed to by the one fact, that's the merger between merger of HDFC with the HDFC Bank. So that is the numbers say that. Of course, RBI has not mentioned that. RBI has said that this is primarily because on account of the money coming back, withdrawal of 2,000 rupee notes, and RBI's surplus gone to the government. Those are the contributing factor. And also, governor has made it very clear there is no bank-specific exemption or penalty. It's for the all scheduled commercial banks. So I think this is one way of, instead of hiking the rate, because the inflation is transient, that's what the RBI and MPC feel. That's why it's a very temporary measure. And future actions will be data dependent. That's it. But for the time being, the banks will have to bear with this. Will it have any impact on the lending rates? We need to see. I'll not be surprised if some banks actually hike their loan rates also for the time being.
That's very well summed up, actually, that it is bullish on growth. Of course, inflation challenges persist. Those are the key highlights of the Monetary Policy Committee meeting this time. And please, thank you so much for taking us through and explaining it all in such an amazing way as you always do, Tamal. Thank you so much.
That was Tamal's take on the latest monetary policy of RBI. It is time now for our poll results. Here's what we asked you last week. Should corporate houses be allowed to enter banking? In a somewhat close result, 44.5% of our respondents said yes and 55.5% that they should not be allowed to enter banking. If you use credit cards, you must be aware that if you pay your dues within 45 days, you have nothing to worry about. But as the payments get delayed, credit card companies charge high interest rates, crossing even 35 or 40%. Is it time that these rates are capped? Here's what we are asking you this week. Should credit card interest rates be capped? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. That's all we have for you today. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.